Good afternoon, everyone. Welcome to Cerebro Capital's webinar today. We're going to be talking about key changes in corporate lending post-COVID. Appreciate your time this afternoon. My name is Lacey Campbell. I'm the Senior Director of Strategic Initiatives here. So I'm going to be your presenter, but I do have a special guest that's going to join us in the middle of the presentation, our founder and CEO, Matt Bionrud. He is a former commercial banker and founded Cerebro almost 3 years ago. He's going to be joining us in the middle of the presentation to go through a case study of a live transaction that we launched prior to COVID and are continuing through the past few months. So you can really see how the lending market is changing through all of this. So we have a couple different types of people joining us today. Some of you are current clients, some of you are prospective clients, some of you may have never heard of us before. So we really appreciate your time. As an agenda of what we're going to go through today, I'll just give you a very brief intro on who we are and what we do, but we're going to spend the bulk of today's time talking about the state of lending. Specifically, what types of deals and loans are getting funded in today's environment, what lenders expect to see from today's borrowers, and who is going to garner enough lender attention to really get to that next level, and who's getting left out of all of this, and maybe what are there other alternatives. And finally, what's next for the loan market as we see it. We do have a Q&A box at the bottom of your screen. We encourage you to post some questions. I'm going to try to address as many as I can throughout the presentation, but if not, we will reserve some time at the end for some questions. So I want to open with just a simple analogy to give you a sense of who we are as a company. Everyone on the phone today could go out to hundreds of different websites online and figure out what the current mortgage rates are. You could very quickly find out who those lenders are, and you could also do a mortgage calculator and figure out how big of a house you could buy. That is a fairly transparent market. In contrast, the middle market, which is what we serve, is very opaque and frankly inefficient. So it's hard for middle market companies to understand what types of rates and terms are out there and available to them. There's a lot of variability between lenders, even name brand lenders who you might think are similar are offering wildly different terms and rates. And it's very time consuming to shop these lenders one by one. And there's really no calculators out there and readily available across all loan types until Cerebro was founded. We launched almost 3 years ago, back in late 2017. We have developed an online marketplace where we are pairing borrowers and lenders through data-driven algorithms. We have deal management tools that assist both borrowers and lenders all the way through closing. We also have a loan compliance platform that is helping borrowers track their loan covenants and compliance. And then with that data, we are able to help borrowers understand the best time to refinance and re-enter the market. So when I talk about the middle market, what does that mean? Well, we are focusing on primarily US-based companies that have at least 3 years of financial performance. Those are both sponsored and non-sponsored companies, and they are seeking loans anywhere from 2 million all the way up to 150 million plus. These are borrowers who are looking for either cash flow or asset-based loans, various debt tranches, and various financing purposes. So it could be everything from growth capital, working capital, refinancings, recaps, etc. We will not be discussing the investment real estate market today. That is sort of outside of our data set. Rather, we're going to be focusing on those traditional loans for operating businesses and how lenders are responding. So I want to share just a couple data points, really how Cerebro is collecting information, and this is going to set the stage for the data we're going to be sharing and sort of the feedback we're seeing in the market today. But in Q2 alone, we took in over $3.2 billion in loan requests coming from middle market borrowers. That was across 1,000 different companies representing 20 plus different industries. So fairly industry agnostic. And what we're doing is we're comparing those company profiles and those company metrics against the 650 lenders who are regularly updating their deal criteria on our platform. And so this is really setting the stage for what we're about to share with you. And that is the lending landscape as we see it today, and also what we think is going to be coming down the road. So before I jump into some specific ideas of various different loan programs, at a very high level, what we are seeing is that there's tightening credit standards across the board. This is not necessarily a surprise, it's probably obvious, but we are seeing consistently that lenders are offering lower loan amounts than previous to the COVID crisis, and we are seeing collateral requirements increasing previous to the standards that were required before COVID. There are also certain types of deals that are getting more lender attention than others, and those are going to be deals that include other ancillary business opportunities. So for example, if a borrower is willing to transfer over all of their treasury management business to a new bank, that's going to get a lender more excited than not. Those businesses that have strong, predictable cash flows. That predictable is the key word there. Many things during this COVID crisis have been completely unpredictable and uncertain. So businesses that have some sort of certainty around their future cash flows are certainly going to get more lender attention. That means that this is going to be companies who are less impacted by the COVID crisis. So those industries such as healthcare or software who potentially benefited from some of these things are obviously going to get more lender attention. We are seeing loans that have stronger collateral, they're backed by fixed collateral specifically, are going to get more lender attention. And that also equates to larger companies. So those companies that have EBITDA over $3 million, lenders are viewing those really as a company who can weather the storm, and that's getting more lender attention. So I'm about to cover some very specific loan programs and the types of loans that are available, the types of interest rates we're seeing. But before I go into that, I do want our founder and CEO, Matt Bionrud, to share with us a case study. This was a live transaction that we launched prior to COVID. And Matt, I'll hand it over to you to tell us sort of how that has progressed over the past few months.
Thanks, Lacey. Yeah, happy to share. So we had a $100 million revenue company looking to do a $50 million recap. They were under 3.5 times levered, and this deal was very financeable from many aspects in the market. We launched it in February and received term sheets from commercial banks and non-bank lenders. The commercial banks had more stringent covenants, but they were close to 4% cheaper on average than the non-bank options. So the company signed a term sheet with a commercial bank and moved into closing diligence in early March. But by mid-April, about a month into COVID, the bank pulled out. The borrower immediately selected an active non-bank term sheet at the same $50 million level and quickly tried to move to close. However, this lender extended their underwriting period by requesting several new diligence items to ensure that they understood the risks related to COVID and wanted to know about all different types of bear scenarios. And as you can imagine, it was difficult to get the lender comfortable because of the inability to predict when things would return to normal from this crisis. So though the company continued to perform well in this environment, they were showing month after month of strong performance, had a good projection for the end of the year. The non-bank lender ended up becoming concerned by the overall environment, and they dropped their credit limit to from 50 million to 15 million. That's 15 at the last minute in late June. And this just ultimately was not acceptable to the borrower. They could not accomplish their goals with that that level of capital. And so they reactivated our platform for MSLP term sheets. And that's because the MSLP program, which was announced in March, was just now in early July becoming active. So this is when the banks could actually start to sell loans back to the government. So the borrower was able to receive from lenders on our platform an MSLP term sheet for $40 million. Though it was $10 million less than the initial request, it was 1/3 of the cost and over 2.5 times the size of the $15 million that was on the table from the non-bank lender. So to summarize, we launched this deal to commercial banks in February. COVID caused the banks to temporarily freeze. So then we pivoted to non-bank lenders, which were willing to do the deal at that time. But as COVID worsened, those loan options started freezing too. And so in response to that, we're able to use the government-backed Main Street lending program to be able to get an option that worked for this borrower. And that is now in July just starting to really heat up. And so at that point, at this point, maybe Lacey, you could give us some more detail on the MSLP program and some of the other loan programs that are out there that people are taking advantage of.
Sure thing. That's a great introduction to the Main Street program. I'm already getting some questions in the Q&A box related to Main Street and MSLP for short. So please continue writing those questions in there. I see, Jeremy, you have some questions about the program. Happy to address that. This is the main program that people are very interested in because it was rolled out under the CARES Act in late March. The SPV from the Fed just opened on July 6th of this month. So it has definitely been a sluggish start to the program. What I want to address at first, before I go into some other specifics, is a little bit of the misconceptions around the program. So first of all, we hear a lot of people calling us a lot of borrowers asking, why are not all banks doing this if the low risk, if there's such a low risk for banks, the banks only have 5%, they're selling 95% to the Fed, why are all banks not doing this? And the answer really lies in how lenders are viewing their risk across their entire portfolio. So they are not offering these loans in a vacuum, to one borrower at a time. They have to look across their whole portfolio. And in some cases, there are lenders who are overexposed in certain areas across their portfolio that they cannot offer even that incremental 5% additional risk for that one borrower. So it's always a matter of how does this borrower fit within the larger picture of a lender. The second thing is we hear a lot of borrowers calling us saying, well, based on the government terms, I'm eligible for up to 6 times EBITDA. And I want to be clear that 6 times cap is a guideline that the Federal Reserve put in place. By no means are banks required to follow those. We are seeing banks who are offering term sheets for Main Street lending at much lower leverage. Much lower leverage multiples. So we're seeing banks coming in, lower, maybe around 3 times, 4 times at most. So they're not really getting all the way up to that 6 times every single time. Additionally, even if you're eligible under the program, that doesn't mean you're necessarily attractive for that specific lender. So it's not surprising that you could be eligible for the program, but still been rejected by a couple different banks. Some terms are better than conventional loans. That's what a lot of people think based on what the media has talked about the Main Street program. A lot of companies believe this is a little bit of a panacea and absolutely the best loan program for them, when in some cases, depending on your company's profile, there could be other loan structures that are a better fit. And I'll go through some of those here in just a minute. Finally, we're seeing a lot of companies who might be wanting to apply for the Main Street program just because it's a low cost of capital and they think that they want some rainy day money. And that is not going to be the best way to go in and get lender interest. Rather, we are seeing borrowers who need to have a very specific use case and a specific plan in order to use those funds. Now, the good news with the program is that it was just announced this morning that the program has been extended through December 31st. So originally the program was expiring on September 30th, but as of this morning, the Federal Reserve announced that it was being extended through December 31st. This is good news. It is going to give a lot of companies more time to get their ducks in order and make sure they have time to apply for the loan. It's going to give more banks time to go through their normal underwriting standards. But what does a borrower need to do to really get more lender interest, or I should say what type of borrower is going to garner more lender interest? That's going to be a company who had strong cash flows in 2019, which means they're eligible for the program. But more importantly, they're also going to have strong cash flows for 2020. So again, that predictable cash flow is important. Companies that have an asset base or are willing to offer a personal guarantee. The loan is, if you read through the term sheets, the government put a really interesting clause in there. It is secured or unsecured. And of course, lenders are asking for these loans to be collateralized. Low impacted industry. This goes back to that predictable cash flows comment. Even though the program is intended to help businesses that have been severely impacted by the COVID crisis, in practice, we are seeing that lenders are gravitating towards those industries that have maybe only experienced a small blip or a small impact rather than those industries that have been severely impacted. Those borrowers that can offer up their other ancillary business banking relationships, their treasury management, et cetera, that's definitely going to be more attractive to new lender relationships. And again, that detailed scheduled use of timing for the borrowed capital is really important. So these loan terms are coming in about 3.25% interest, really low interest, which is great. It is a 5-year term and the principal and interest is deferred. But in practice, the big takeaway I want you all to understand about the Main Street program is so far, and that this could absolutely change as the program matures, but as of now, based on the data and all the deals that we have out in the market, we are seeing that lenders are really using Main Street as an incremental debt tranche. So rather than offering a term sheet, we're using a full Main Street lending program structure. They are more often than not coming back to our borrowers and offering some portion of the debt package within a conventional loan, and then offering the Main Street program as that additional piece on top. So that incremental piece, and that is allowing the banks to stretch a little bit beyond their normal limit, but they're trying to fit as much of the debt request into the conventional loans as possible. So let me talk about the conventional loans. That's a good transition. As I mentioned, banks are still trying to fit as many people into this bucket as they can. So what are the lender expectations to fund under the conventional loans? Well, there are two types. The first is the cash flow. So any companies that have less than 10 million in EBITDA, commercial banks are going to be looking for full collateral support. They are going to be looking for the cash flow leverage to be below that 3 times. If the company is looking for more than $10 million in the loan size, they're going to expect they have audited financial statements. And keep in mind that there's also going to be a request for companies to put together more detailed projections and more detailed downside scenarios, bear case scenarios when they do their modeling. These conventional loans, they're coming out somewhere between LIBOR, LIBOR plus 4 to 8%, and those are typically 3 to 5 year loans. Now, there's also asset-based loans within the conventional and the commercial banks. These are loans that are still definitely getting funded right now. So EBITDA needs to be above that 1.25 times debt service coverage. The collateral requirements are increasing versus what they were prior to COVID. And so that means that from the loan term perspective, they're looking at smaller advance rates, essentially on the asset base. I would expect that borrowers, if you're looking for an asset-based loan, to be a little bit more flexible on some of the timelines to accommodate some of the lockdowns, and also appraisals. If appraisals are necessary, there's some states where that has been shut down, so that's causing some delays there as well. Now, switching over to another loan program to consider, I want to briefly mention the SBA program, specifically the SBA 7A and the SBA 504. These are loan programs that were in place prior to the COVID crisis. So these are not the specific loan programs that were rolled out under the CARES Act, and these are not the EIDL or the Economic Injury and Disaster loans. Rather, these are loans that have been in place for years, and we are seeing that lenders are still absolutely funding under these. Now the SBA 7A program only goes up to 5 million, and the SBA 504 only goes up to 25 million respectively. But these are good loans to consider if you are looking for M&A activity. The cash flows, should exceed 1.15 times fixed charge, and I would say that fixed collateral is often requested by these lenders. Now, in comparison, these loans are coming in roughly about 6% interest rates, but they're in up to a 10-year term, which means that the payments could be in some cases, lower than other loan options. Now, a personal guarantee is typically required for these loans, so something to keep in mind there. But because of the lower origination fees and longer terms, these might be really attractive if you're looking for those smaller loan amounts. Now, there's definitely an opportunity with non-bank lenders as well. So everything that I've focused on prior to this has been loans that have been offered through the commercial banks. I want to now talk about what are the non-bank lenders doing. If you're not familiar with non-bank lenders, these are private debt funds, mezzanine funds, venture debt lenders, SBICs, etc. And they really look for deal sizes over $5 million. So if your company is looking for more than $5 million in a loan, this might be a good avenue. They do offer higher leverage limits and leverage multiples. There is a preference for sponsor-backed or really strong valuation upside companies. The non-bank lenders are more flexible, and so they're also a really good avenue if you're doing any sort of M&A activity or growth capital. There is less of an emphasis on collateral with non-bank lenders and less of an emphasis for personal guarantees if the EBITDA is over $5 million. These lenders, now the interest rates are going to be higher. So you're looking at somewhere between LIBOR plus 8 to LIBOR plus 15%. But the terms are 3 to 5 year terms, and there are interest only structures. Sometimes there are prepayment penalties, but I want to stress that they are absolutely more flexible in some cases and a better avenue for some type of borrowers. Overall, they're just not burdened by all the regulation of some of the new government-backed programs, and they have a lot of capital they need to deploy. So they're certainly looking for new opportunities there. So who's being left out of all of this? Well, there's really three main buckets that I want to cover for borrowers who are not getting enough lender attention in today's environment. And the first are those industries that are severely impacted by COVID. So those are the hotels, the restaurants, the travel industry, retail space. Even though the Main Street program was specifically intended to help these type of businesses, in practice, we are seeing that lenders are really taking more of a pencils down approach because of the lack of reliable financial projections. It goes back to that predictable cash flow point that I made earlier. So there's still a lot of uncertainty about reopening timelines. Now we are hopeful this could change, especially as the Main Street program matures. But as of now, there's really that type of industry is getting left out. The second bucket are those asset-light companies that are in between and are seeking between $5 to $10 million. So it's a little bit of the Goldilocks problem. So if they are too big for the SBA, and remember the SBA 7A program caps at $5 million, it is a good avenue for asset-light businesses. But if they're too big for that, yet too small for the non-bank network, remember, non-banks are a good avenue for asset-light businesses who have consistent EBITDA above 5 million. But if they're in between, they are really getting left out of a lot of the programs right now. And finally, the acquisitions. I see there are a lot of questions in the chat window there about acquisitions, particularly under the Main Street program. So a couple points here. One, in general, M&A activity is still viewed fairly risky from the commercial bank sector. There is definitely a higher scrutiny on the EBITDA add backs. And the Main Street lending program is not intended for the specific purpose of acquisition financing. Now, the Federal Reserve has remained silent on this point, so it is not explicitly prohibited, But we do believe, and we've seen early indications that lenders are going to be a little bit more conservative in their interpretation and use the Main Street program more as a true working capital line rather than that M&A activity. So what's next? How do we approach the next few months, and what do we think 2021 is going to look like? Well, in short, we really think the future is now. So the Main Street program is ending December 31st. This is a brand new change that was just announced this morning. Previously, it was expiring the end of September, so people were a little bit more under the gun to apply for that program. But we do still recommend, if that's something you're considering, that you should put your ducks in a row right now for the Main Street program. Now, the government stimulus is going to be highly politicized, as it already has been, but given that we have an election 4-ish months from now, we believe that the success of these government programs, as well as any future government programs, are going to be highly politicized. And that could be a good thing and a bad thing for a lot of borrowers who are out in the market right now. In general, we believe that banks are going to be pretty defensive over the next 6 months. That's because many of them have existing portfolios that are highly impacted by the crisis and are likely going to be in default. So those banks that have a higher than average number of borrowers in default are going to be looking at defensive positioning. In contrast, the borrowers should be aware that banks could be forcing them out and pushing them into the non-bank network because they might be coming up for loan defaults, and banks are going to be defensive and trying to realign their portfolios. So definitely be aware that could be around the corner. And finally, we really see that this uncertainty in the market that we've experienced these last few months, we see this continuing and really being the new normal until there is a vaccine for COVID in place and readily available. That leads back to that point about predictable cash flows. Until there is a vaccine implemented, lenders are going to see many industries as having too much uncertainty into what could happen. And until that vaccine is in place, we see this variability in the market continuing. So what should borrowers do? Well, we really think that you should start planning today. So if you have loan facilities maturing less than a year from now, less than 12 months, definitely you should be evaluating the Main Street program. While it is not the best use case for everybody out there, everybody should at least put it on the table as an option to consider. And if you are interested in that, you should start the loan package now. Even though the program's been extended, it's in your best interest to get started sooner than later. For those borrowers that have loan facilities that are maturing in late 2021, we still recommend that you start scenario planning now, looking at that balance sheet and identifying opportunities to increase your cash flows and your assets in order to put you in the best position possible to go out and seek a loan when you need it. Now, how can Cerebro help? We hope that today's presentation has been helpful, but we do want to offer 2 other tools that could benefit you. Number 1 is our loan assessment. It is entirely free, no cost, no obligation, and we do help corporate borrowers understand what loan options are available to them. Generally speaking, which type of programs they could be eligible for. There is a link on our website, and we will make sure to send that out after the presentation so everyone has access to it. For loan compliance, for those borrowers who have existing loans in place and need a better way to track their covenant compliance, making sure that they are double checking everything that is in that loan agreement and making sure they're not giving those banks any excuse to push them out. We have a loan compliance software that can help with that, and we will be sure to send over some more information and a link. My contact information is at the bottom of the screen as well. I'm happy to answer any questions. Feel free to reach out to me directly. And with that, I'll really wrap it up. I appreciate your time today, and we hope that we can be a resource for everyone on the line. Thanks for your time.